You know, for over a decade, Netflix was the poster child for disruption. This was the company that made Blockbuster a relic and completely rewrote the rules for Hollywood. But what happens when the disruptor becomes the incumbent? Well, with some big leadership changes and a stock dip after earnings that made everyone sit up and pay attention, the market is finally asking that exact question. So today, we're going to break down what's really going on with one of the original tech titans and why the way you've been valuing it might be completely wrong.
Okay, let's start right here, because this quote, it isn't just a catchy line. It's a whole investment thesis packed into 2 sentences. It's basically saying the company's DNA has fundamentally changed. The engine that powered its crazy, world-conquering growth has cooled down, and what's left is a very successful, very mature media business. So think of it less like a rocket ship that's still blasting off, and more like a massive, profitable airline that just flies the same established routes day in and day out.
And look, this isn't just some theory people are kicking around. We're actually seeing it priced into the market in real time. That 10% drop after the announced earnings, that wasn't just a random bad day. It was a moment of real panic from investors. See, when a darling stock stumbles like that, Wall Street doesn't just ask what went wrong this quarter. It starts to question the entire story. Is the magic finally starting to wear off?
So this is the million-dollar question, right? Are we just watching a great company hit a little speed bump on its way to total domination? Or has Netflix crossed a kind of one-way bridge? A bridge from being a high-growth tech stock to being a stable, kind of slow-growth media utility? Answering that question changes absolutely everything: how you value it, what you expect from it, and frankly, where it even fits in your portfolio. And today, we're going to build the case, piece by piece, that reclassification has already happened.
All right, to really get what's going on with Netflix, we need a solid framework. This isn't about gut feelings or whether you like their latest original series. No, this is about the powerful economic forces that explain how these digital giants win in the first place, and, just as important, how they eventually grow up and settle into a totally new reality.
Now this right here, this is the key that unlocks everything. Aggregation theory explains Netflix's entire rise to power. See, in the old world, power meant you owned the supply, the movie studios, the cable infrastructure. But this theory says on the internet, where getting stuff to people is basically free, power shifts to whoever owns the customer. By building the absolute best, easiest-to-use experience, the best recommendations, the smoothest interface, Netflix gathered millions and millions of users. They didn't own the pipes, they own the audience. It's exactly what Google did for information and what Amazon did for shopping. And this just perfectly illustrates the journey every single one of these successful companies takes. Stage 1 is that crazy Wild West land grab. You're just pouring money into growth, getting users as fast as you can. For Netflix, that was pretty much from 2007 to around 2020. But then you hit stage 2, saturation. You've gotten most of the easy customers. And that's when the game completely changes. You enter stage 3, defending your castle. Your focus isn't on offense anymore, it's all defense. Things like cracking down on passwords, tiny price hikes, introducing an ad tier. Those aren't growth strategies. Nope. Those are classic stage 3 moves to squeeze every last dollar out of the customers you already have.
This is such a critical distinction to make. Blockbuster wasn't caught in an incumbency trap, it was made obsolete. A brand new technology, streaming, came along and made its entire business model of physical stores totally worthless, almost overnight. Netflix isn't facing that. No new tech is coming to kill streaming. Its problem is the incumbency trap. And the trap isn't that you get replaced. It's the slow, grinding process of just becoming a utility. Your growth slows to a crawl, and your focus shifts from game-changing innovation to just optimizing the machine. It's definitely less sexy, but it's the destiny of almost every successful disruptor. So, let's take a little advice from the investing legend Charlie Munger and just flip this whole problem on its head. Instead of asking, how can Netflix keep growing like a tech company, let's ask, what's the cold, hard proof that its hyper-growth days are already behind it? And when you invert the question like that, it points you right to the numbers, and that's where the real story is. All right, let's get into the hard data, because a company's real strategy, its limits, its ambitions, it's all buried in the fine print of its financial reports. This is where the theory of Netflix, the media utility, really slams into the facts. This number here is the subscriber acquisition cost, or SAC. Put simply, it's how much money Netflix has to spend on ads and marketing just to get one new person to sign up. And folks, this number is the smoking gun. In markets that are already saturated like the US and Canada, this cost has just been going through the roof. When it gets this expensive to find new customers, that whole exponential growth story just breaks. It's the brutal truth a lot of investors miss. They see the big, flashy brand, but they don't see the engine underneath starting to sputter.
And this chart, wow, this gets to the absolute heart of it. For years, the story was simple. Spend a ton on content, get more subscribers, stock goes up. But this chart shows the law of diminishing returns in action, big time. The idea that spending another billion on content will get you the same growth as the first billion did, well, that's just not true anymore. Think of it like watering a plant. At first, water is essential for it to grow, but once the plant is fully grown, pouring more and more water on it doesn't make it any taller. That massive content budget just isn't buying the growth it used to.
You know, a lot of people on Wall Street thought the new ad-supported plan was going to be the next big growth engine. But the reality? It's much more of a defensive move. It's not really about attracting millions of brand new users. It's a release valve. It's for giving existing subscribers, the ones who are getting tired of the price and are thinking about canceling, a cheaper option so they stick around instead of just leaving for good. That is a classic incumbent move to protect your revenue, not a disruptor move to conquer new territory.
So this is Netflix's core operating margin. Now, is a 24% margin good? Of course it is. That's a super healthy number for a profitable, well-run company. But here's the thing. It's the margin of a big media company, like a Disney or a utility. It is not the margin of a fast-growing tech company that trades at a crazy valuation. The numbers are telling us what the company is today, not what we remember it being 5 years ago.
You know, there is no more honest signal about how a company sees its own future than how it decides to spend its money. And Netflix's recent moves in the world of big-time mergers, well, they paint a crystal-clear picture of a company that's choosing the quiet discipline of an incumbent over the risky, go-for-broke ambition of a disruptor.
So let's just walk through this whole Warner Bros. Discovery saga. You have Netflix reportedly putting a massive offer on the table to buy this legendary library. We're talking DC Comics, Harry Potter, HBO, the works. Then a bidding war starts. The price gets driven way up. And right at the moment when a classic disruptor would go all in, do whatever it takes to win, Netflix does the unthinkable. They fold their cards, and they just walk away.
And the market was split right down the middle. Was this a total failure of nerve? Did Netflix lose its killer instinct, missing out on a once-in-a-lifetime chance to buy up these incredible assets? Or was this a quiet masterclass in financial discipline from a management team that looked at the numbers, saw the price was just too high, and refused to overpay just to keep a growth story alive?
The answer, my friends, is right here in this number. This was the breakup fee, a windfall of over 2.5 billion euros that Netflix got for losing the bidding war. Just let that sink in for a second. They got paid a fortune to not make a super risky, incredibly expensive purchase. That's the move of a smart, value-focused operator, not a growth-at-all-costs visionary.
And this is the final, most important piece of the puzzle. What does Netflix do with all that cash? Do they pour it into some crazy new moonshot project? No. They announce a plan to buy back their own stock. This is the ultimate endgame move for a mature cash cow company. It's management signaling to the market, hey, we've looked at everything we could possibly invest in, and we've decided the best return we can get for your money is to just give it back to you by buying shares. That is textbook utility behavior.
Okay, so when you put it all together, the theory, the hard numbers, the way they're spending their money, it all points in the same direction. And this means we basically have to throw out our old playbook for analyzing Netflix and write a totally new one.
This table just lays out the mental shift perfectly. For years, we all looked at Netflix using the column on the left. We were obsessed with subscriber growth, paid these crazy speculative valuations based on a story about the future. It's time to start using the column on the right. The key metric isn't subscriber growth anymore, it's free cash flow yield, how much actual cash the business is spitting out. And we should be thinking about its intrinsic value, what it's worth today based on real profits, not some dream about tomorrow. So let's make this super practical. Your new toolkit means you stop asking if Netflix can add another 50 million subscribers, and you start asking what its free cash flow yield is. You judge that huge content budget not by its size, but by how efficient it is. And you start to see share buybacks not as a sign of weakness, but as a smart, disciplined way to return value to shareholders. It's about analyzing the company that exists today, not the one we remember from 10 years ago.
And let's be crystal clear about something. This analysis is not a recommendation to buy or sell the stock. Calling Netflix a utility isn't an insult. I mean, some of the best, most stable, wealth-creating companies on Earth are utilities. The whole point is, you have to know what you own. Understanding the shift from disruptor to incumbent gives you a huge analytical edge because you can see the company for what it actually is and value it the right way.
And that leaves us with one final, pretty provocative thought. Netflix is one of the very first of the great digital giants to go through this entire life cycle, from disruptor all the way to incumbent. But it definitely won't be the last. As the other big tech companies get older and saturate their own markets, they are all going to face their own version of this incumbency trap. So the real question you should be asking now is, who's next?